Intermediate Forex course, Advanced Concepts and Strategies for Successful Forex Trading. Here, friends Okwudiri, friends Chimezirium Okwudiri, I am your host, I'm your presenter. Any question you might have, don't hesitate to drop it in the comments. Here, this is about you, and seeing to it that after you've taken the beginners, which you already you have gone through, no matter the level you might be in Forex trading, that is really something for you to learn from this intermediate course. This is to make it easy for you, demystifying, decoding the Forex market, giving you an effortless, seamless journey ahead. So here I am committed to ensuring that you learn all you need to learn to become a profitable trader. So let's get to it. Now, overview. All right, we're going to cover in this model, firstly, introduction to the Forex market, currency pairs and quotes, market session. Also, we're going to talk about support and resistance. Also, we're going to look at some candlestick patterns. Also, looking forward, we're going to make a very quick overview of economic indicators. Also, we have our introduction to trading. And fourthly, we'll be looking at risk management, risk to reward ratio, basic risk management strategies, all into this class, but to some extent, okay, as we keep on moving forward, we keep on diving deeper and deeper into that. Today, we're going to be measuring basically on the introduction and currency, candlestick patterns, and support and resistance. Let's keep moving forward. All right, now, introduction to the Forex market. This is the largest and most liquid financial market. The market participants, I'm getting a glitch on my screen. Let me see how I can get that corrected. Okay, I believe we are good now. We are good. Okay, so introduction to the Forex market. It is the largest and most liquid financial market. In all financial markets, it is the highest and the largest. That is to say, a lot of money can be made. Over $6.7 trillion are traded on average every day. Now, who are the market participants who are involved in Forex trading? The central banks, financial institutes, corporations, and traders, retail traders, traders like you and me, even as we learn and as we keep on advancing forward. Now, moving forward, what are we going to discuss? Currency pairs and quotes are the fundamentals to everything. Forex trading involves trading. What are you trading? You're trading currency pairs. So it's very important to understand it. For those of us that have been through the beginners, this will be like a quick brush through as we keep on moving forward. I don't want anyone to be left behind. All right. So we have the base and the quote currencies. Example, Euro, US dollars. Here in this case, Euro is the base currency and US dollars is the quote currency. We have types of currency, majorly three types of currency pairs. Major currency pairs, these are currency pairs that has US dollars involved in it. Let me say the top world economy quoted with US economy. Example, Euro US dollars, Great Britain US dollars JPY. This is a major currency pair. Also, we have the minors. The minors here are still the world top currencies, but in this case, the US dollars is not included. This is an example of Euro GBP, GBP JPY. Then we have the exotic pairs. These exotic pairs, you can say they are from third world emerging currency economy power, where we have quoted with US dollars. All right. So USD TRY, USD ZAR. Okay. Yes. Now moving forward, we have market sessions. All right. We have market sessions. I hope this glitch is not actually reflecting on your screen. Let me check if it's actually showing, because I want to ensure that everyone here has a seamless viewing experience. Okay, that stopped. Now we have basically 4 market sessions. Okay, we have the Sydney session, we have the Tokyo session, we have the London session, we have the New York session. Now, some of these characteristics are, okay, the largest and most liquid financial market is obviously Forex trading. I already mentioned the participants are the central banks, financial institutions, corporations, and retail traders. Okay, so now these sessions are, let me say, when these banks are open, when the Sydney banks are open in their own time, usually in their own time around, let me say, 8 a.m. to 5 p.m. So because of the, when you're trading, they have different time zones. So that's why you have to monitor these time zones when you trade. Let me say you could be trading US dollars. You want to be trading US dollars when, let me say you're trading GBP US dollars. It is best for you to trade it when this currency time, when these time zones are actually open or overlapping. It gives you more volatility. If you're trading the pair when the time zone has closed, it tends to be less volatile, and in most cases tend to range a lot. And in forex trading, what we do mostly is trend following. So you don't want to trade a choppy market or a ranging market. So that's why it's best to trade it during the active trading session. All right. Now, these quick questions I usually get: what is the best trading session to trade? The best trading session actually depends on your strategy and the currency pair you're using. If you're trading, let me say AUD US dollars, you want to trade it when AUD US dollars are opened, or when that is when they overlap, or at least one of them is open. Okay, basically the best time to trade is actually when they overlap. That is the best time to trade a currency pair, because if you notice at that point there is a lot of volatility, a lot of liquidity and volatility. All right. So, however, when two market sessions overlap, they are often considered the best due to high volatility and liquidity. As I said, when the two of them are open, there's a lot of movement, a lot of traders, a lot of movement, a lot of volatility, a lot of liquidity. So, as a forex trader, high volatility, high liquidity means a lot of moves. You know, our pricing, our wins or losses are calculated in pips. So now these pips tend to be high and massive when these currency pairs are overlapping. You don't want to stay in the market wasting too much time and the market just keep on ranging and ranging. You want to enter a market at a good point and easy peasy, your take profit has been achieved. Or in this case, in a negative case, your stop loss has been hit. Then you know what you're doing, you move on to the next chart or you move on to the next day. So it's good to trade a session where it is opened, also depending on your strategy. All right. But in most cases, when the sessions are open and they overlap. Now, what do we mean by open and overlap? This is what I'm talking about here. Now, examples of diagram. This time session is GMT. All right. Accra, Ghana time, GMT, not GMT plus one, just GMT. So at GMT, 7 a.m. GMT, that is when the London session opens, and 15 p.m., like 3 p.m. GMT, that is when the London session closes. Now, if you want to trade GBP USD, that is London US dollars, the best time to trade is when the both of them overlap. In this case, 12 p.m. GMT and 15 p.m. GMT. So these are the intermediate stuff we're looking at, not just the beginners, but we're advancing and moving forward. All the same, keeping it easy for everyone to understand. All right. So the best time to trade a currency pair is when the sessions overlap. It gives you high volatility and high liquidity. Now, moving forward, I'll ask the question. In the comments, you can just drop a comment, your own time zone. All right, your current time zone, drop it there. Now, this is an example of a time zone, GMT plus one. GMT plus one is a West African time zone. Usually, Nigerian time is GMT plus one. So if you're in Nigeria, trading from Nigeria, look at your time zone. You could be like, okay, from 8 a.m. Nigerian time to 4 p.m. Nigerian time, this is when the London session is open. So if I want to trade GBP US dollars, the best time to trade GBP US dollars, the best time to trade where you have a lot of liquidity and volatility, all right, is when 1 p.m. to 4 p.m. This, if you notice, if you look at your chart, these are the times where there tend to be a lot of volumes. So massive volumes. All right. Now, if you wanted to trade AUD JPY from someone that is in a GMT plus one time frame, then you'll be like, okay, the best time to trade it is actually 12 a.m. 12 a.m. all the way to 6 a.m. These are the best time to trade Sydney related Asian session currency pair. All right. Example, AUD JPY. Now, moving on forward, we already know our currency pairs. Okay. So currency pairs are characterized, of course, two currencies traded together. We have the bid price, we have the ask price, we have the base currency, we have the quote currency. The base currency, of course, the first currency and the most strongest currency. And then the quote currency is the second currency and is the weaker currency. All right. So when you're actually buying a currency pair, you're actually buying the base and you're selling the quote. Okay, so that's just it. So what we call spread. Spread is a difference in price. Let me say here for this example, we have 1.1916. That is the bid price, and then the ask price we're seeing 1.1918. That is to say the spread here is 2 pips. 2 pips. Remember, pips is the smallest price change of movement of a currency pair. All right. So when you want to trade, you want to look for a broker that gives you low spread, not high spread. You can see it this way. Spread could be the charge or the commission the brokers take to validate your trade. You can put it as a mental time frame. Put it in your mind. So when you want to trade, you don't want a broker that is taking a lot of spreads, because especially for scalpers, this can affect them a lot. If you want to scalp where you're scalping for just a quick 10 pips, 15 pips, 20 pips, these pips counts can really matter. There are some brokers that you can see Their spread could be all the way to sometimes 10, sometimes 15, just insane spread. So you want a broker that gives you tight spread as possible. So now moving forward, now these are exercise. Do your due diligence, write this exercise, take them down. If you have access to Friends Forex community or DeluxeDealers Training Academy, get into it, put your assignments there. It can be reviewed by experts who will review it and give you the solutions if you're wrong, because this is a learning journey. So these exercises are here to test your experience. So here, this is it. Exercise number 1, list 5 major currency pairs. List 5 major. Remember, major are the currency pairs that has what and what, guys? What and what? Can I see a comment there? Okay, has the word one of the top leading economy power paired up with US dollars. Example, Euro USD, GBP USD. So list 5, identify the base and the quote currency. That's it. Now, number 2, match the currency pairs with their appropriate market section. Okay, so let me say we have example AUDJPY. You mark it with the appropriate trading session. All these exercises are to make you evolve as a trader advancing forward. So you don't just be a trader that is just, I don't know, not intentional, wasting time and being among the top. Fortunately, the statistics, 90% of traders were profitable. So to be profitable, you have to learn the right way, keep learning, keep journaling, and knowing that trading is a continuous process, not a sprint, not a marathon, but it's actually a slow process. So you have to learn, take your time to learn, and keep on growing. At Friends Forex and at DeluxeDealers, we are here to mentor you and to coach you in the right way. All right, now, okay, basic technical analysis. All right, so we start with support and resistance. As the class keep on moving forward, we keep on evolving and advancing forward. Now, what is a support level? All right, these are common terms you hear in the forex market. Support level, even as the word says support, okay, is the price level where a currency pair tend to find buying interest, preventing it from falling any further. In most cases, that is where a lot of buyers are actually coming in. They see this market to be too cheap at that point. They want to get in, and when a lot of buying pressure comes in, it pushes the market upward. It finds support. It finds it difficult to break that level. All right, good. Now, resistance level, as the word says, resistance is a price level where a currency pair tends to fail. How do I put it? It's a price level where a lot of sellers come in. When a lot of sellers come in, that market is actually going down. So a lot of sellers are coming to push it down, and it fails to go any higher. It's like a resistance trying to stop it from moving any higher. So that's how it sounds, okay? Resistance, preventing it from going higher. You can call it a ceiling, and then support. You can call it a bottom, rock bottom. Not just rock bottom, but it finds encouragement, it finds support, and then it moves up from there. So support and resistance are one of the basic fundamental powers when it comes to trading. Moving up forward in the support and resistance dynamics, we have the demand and supply. You know, according to the rules of economics, when there is a lot of demand, the price of an asset tends to appreciate. Then when there is a lot of supply, the price tends to depreciate. This is the financial market. So of course, so demand is actually, you can call demand on a beginner level, okay? You can call demand a support level. But bear in mind, please, not all support level are actually demand zones, but we keep on moving forward in that. We keep on moving. I don't want to go much into the advanced. We're still keeping it. This is an intermediate class. We keep on growing together, having a fun learning environment. All right. So a supply level, it can also be said as a resistance level where a lot of selling interest comes in. Now, looking at this chart right here, this is our resistance level. When the market tapped into resistance level, it sold, came back again, tapping into that same level, it sold. Came back again, tapping into that level, is sold. What are we doing here? The demand level. Okay, from here, the market came, tapped into this level, found resistance, fell, came back to this our support zone. And then what happened? A lot of buyers came in, pushed this market up, all the way up, came back to resistance, fell. Now, there is something you need to understand. A market doesn't always continue in a certain pattern. Okay, we have 3 types of trend: the ranging trend, the uptrend, and the downtrend. Eventually, a support level can be broken. So is a resistance level. And the market has a beautiful way of doing its works. That when a support level is broken, it tends to act as a resistance level. And when a resistance level is broken, it tends to act as a support level. All right. Now, when you want to make your financial analysis, you have to understand support and resistance. All right. So how to draw support and resistance line on a chart to identify potential zones in the market, potential trading zones. How do you do it? You simply you identify the consecutive lows. You look at your chart where you've seen a lot of bottoms, yeah. You go there, you draw a line there, or you could use a horizontal tool. You put your horizontal tool there, and that will be your support level. A lot of bottoms, right? Now, where there is a lot of peaks, finding difficult to break a zone, you go there, you draw it. That is obviously you're seeing your resistance zone. I love to call it a zone, not a line, because it's actually a zone, not a straight line. So you can use a zone, a rectangle to draw it along. Okay, in our subsequent class, we'll have a live session where I get to show you that depending on the time of the class. Moving forward, okay, everything we are talking about here, we'll all practice it together. I will all show you everything. But I hope this is easy to learn. I hope this is easy to understand. Remember, a good student is a student that practices what he learns. So practice makes perfect. All right, we're still moving forward. Okay, so what are we talking about next? We're talking about what? Candlesticks. Candlesticks. Before we move on to candlesticks, we use TradingView to make our trade analysis. We can also use TradingView to make our trades. So by this time, I believe, as you have passed through the beginner's level, you obviously know about TradingView. So with the TradingView, do the exercise, mark up your support level and your resistance level. Always feel free to reach out if there is any question or if there is anything unsure to you. We are here to coach you. All right. Now, candlestick patterns. Okay. Now, basic candlestick anatomy. All right. Here, when you see a red candle, that is from that period in time, that candle depreciated in price. Here is the high this week. This is the high. This is the low. This is the opening price. It opened up and then it closed low. It actually depreciated. That is how a bearish candle is. Now, looking at a bullish candle means a candle that appreciated within a given period of time, depending on the time frame. If this is a 4 minutes time frame, or let me say if this is a 5 minutes time frame, then this candle represents 5 minutes. If this is a 15 minutes time frame, then this candle represents 15 minutes, depending on the time frame. Now from here, this is the low, obviously. All right, this is the low, this is the high. Now the body tells a story. If it's a green candle, the body from the bottom signifies when the market opened at that time frame, at that given time frame, the price the market started. It started here and then it closed here. For the fact that it started low and closed high, then it's a green candle, bullish. All right, we call it bullish, is appreciating. But for the fact that it started high and then it went low, we call it bearish. All right, a red candle. Now, moving forward, we have common candlestick patterns and they signify different things. See, candlesticks help you understand the psychology of the market, understand what other traders are doing. So candlesticks is actually, as a forex trader, you're a market whisperer. Your ability to understand the dynamics of the forex market, the moves of the market is communicating with you. Amongst the tools used in listening to the market is the candlesticks. All right, so let's talk about some candlestick pattern and what they are saying. Here we have spinning tops, we have shooting star, we have the hammer. When you see a hammer pattern, it tells you that the market is about to buy. Shooting star is about to sell. Spinning tops, not too clear, but you want to see the next candle that forms after it. A doji is an indecision candle. Okay, nobody is actually in charge. An engulfing candle, bullish engulfing candle, that is to say, okay, buyers are actually on top and are pushing this market forward. Now, when we hear a bearish engulfing, at that point in time, a lot of sellers came in. That means there is a high chance of this market selling at that point. An evening star, this is also, as the word said, evening star. It is going down, going down. That's what that pattern means. Then a morning star actually tells you, okay, this market is about to appreciate. Most traders, they will just open their trade at this point and put their stop loss below the low and then keep riding. But we'll just keep moving forward, one step at a time. Now, something they call three soldiers. Three soldiers, when you see three consecutive bullish candle in one direction, okay, that signifies a lot of bullish pressure. A lot of buyers have been in this market currently. And what you want to do as a forex trader, you're a true trend follower. Follow the trend. Follow the trend. The trend is your friend. When a lot of people are actually buying, you want to follow them and buy. But the thing is this, you want to buy at the right point. Don't just buy when the market has bought a lot. When the market has gone too far without you, it's best to leave it, because you don't want to enter when the market has gone in too high. Then when the market begins to retrace, they begin to cash unnecessary loss. You don't want that. Now, there's something we call three crows. These are three subsequent bearish candle going in a direction. 3 crows. All right, these are just common patterns, but still moving on forward, demystifying everything, making it easier for you. Dogee, as I said, Dogee is a candle with a very small body, indicating market indecision. That means like a tug of war between the buyers and the sellers. No one actually won, so there was indecision. So you don't have a clear bias. You want to see what's going on. Now, if the market is actually trending, let me say it is going down all the way, then all of a sudden you're seeing an indecision candle. That means, okay, wait, the sellers are actually not so sure of themselves. Also, buyers are actually entering. That means this thing, there is a potential that this market could reverse. So you want to watch. Beautifully speaking, also, it's not just where a candlestick forms, but it's not just the formation of a candlestick, but it is the location at which it forms. If a candlestick, let me say we see a doji forming at a resistance level. Let's say this market was buying all the way. It went to a resistance level, formed a doji. That means there is a chance, that is an indecision. Then the next candle, you see a bearish candle. That is an engulfing, that is a confirmation to sell the market, because at the resistance level, the market wants to sell. Now the market went in all the way, tapping into that resistance level, gave us a doji. All of a sudden, that means you want to sell. Also, this is a very good chart example. It is not just the candle formation, but where it forms that matters. Here, a doji formed. This was not a support level. It formed. It did not really hold much water, but it actually signified a reversal, a possible trend reversal. The market still kept on going down. Remember, the trend is your friend. So don't just go fighting against the trend. Find yourself fine-tuning your strategy to follow the trend. Be a good trend follower. Now here, the market went to giving us a good low. This is most likely a demand level or a support level. Gave us an indecision. After an indecision, whatness, we got ourselves a very good bearish strong candle. Someone can call all this 3 formation a morning star. You take your trade. Your stop loss will be below the doji zone and your target to be at the next market significance high. But we'll take everything one step at a time. Okay. Now, still moving on forward, look at it. A very good example of a doji. So here we had ourselves, someone can call this a resistance level, and here someone can call this a support level. Okay. Now the market came tapping into our resistance level zone, blah blah blah. What happened? Okay, even from here, this is an inverted hammer, but let's just keep it. Let's go on to doji. Here we have a doji. After the doji candle, indecision, whatness, a bearish candle, and at what location? Around a resistance level. That is to say, okay, the market is actually going to sell. You put your sell, your stop loss here, your target to get the next low, which is your demand level or your support level. When you target that, eventually the market came into hitting your take profits. So this is just on the basic level, but we'll keep on advancing forward, making you understand. If there is anything you don't understand clearly, don't hesitate to drop a comment after the session. I will attend to your comments. Yes. Now, moving forward, we have what we call the hammer. All right. It's called the hammer for a reason. We have the bullish hammer is actually a reversal pattern with a long wick and a small body. A very long wick and a small body. That is it. Looking like a hammer right there, right? A very long wick and a small body. It indicates buying pressure, okay? Buyers are coming. But we have 2 types of hammers, okay? We have the normal hammer and the inverted, okay? But let's just one step at a time. Now there was a downtrend, obviously. Then the market came down to, let's say, a demand level or a support level. Then we find ourselves a hammer, okay? It says a potential. It doesn't mean the thing is going to just change. You have to watch it. Then we watch the next candle. That was a very strong bullish candle. This 3 candle formation here is also a sign of a morning star. You take your trade at the zone, your stop loss will be just here, and then your target all the way, making profit. So this is it. Candlesticks help you understand the psychology of the market. Moving forward, we have what we call the hanging man. The hanging man, for a reason, is a bearish reversal pattern, okay? Indicates that sellers are pushing the price during that period, okay? Buyers are not able to surpass the sellers. Buyers started, but before that candle closed, sellers entered, and then it tends to close in that formation, okay? It suggests weak momentum in an uptrend. If you see that thing forming in an uptrend, just know that these buyers, they're actually losing power. They're losing the tenacity. Sellers are actually trying to come in. Then you observe it. Wait for the next candle. If that candle is in alignment with, let me say that candle now formed bearish, and also the hammer formed, the hanging man, okay, formed at a resistance level, that is your confirmation to take a sell trade. As simple as it is. You take your sell trade, your stop loss, and your target. That's it. Okay. So moving forward, we have something that we call the shooting star. All right. The shooting star. it is a bearish reversal pattern. It doesn't mean that it's actually going up, okay? It's a bearish reversal pattern. Anytime you see it after an uptrend, especially at a resistant level, is actually telling you, okay, buyers are actually going out of this market. Sellers will most likely enter. Wait for the next candle that forms. Forming bearish, you can actually take a trade, and your stop loss will be above the wick of the shooting star, and that's it. That's how you make profit trading the forex market. This is just on an intermediate level, but there are so much more things to look out for as you're trading. But even with these basics, you're actually going to be able to make some profits, some winning trades, okay, some winning trade. But to be consistently profitable, you have to improve your skills. You have to be a good listener. So in life and in everything you do, be a very good listener. Read behind the lines, understand everything. Don't just take the first thing you hear, but understand and read behind the lines. So as a forex trader, as a financial analyst, you have to be a very good market whisperer. So you have to improve your communication skills with the market. And we start doing that by understanding market psychology, which is through candlesticks. All right. So moving forward, what other thing do we have here? Here we have the engulfing candle. This is one of my favorite candles. All right. Engulfing candle is a reversal pattern where one candlestick engulfs the previous one. Remember what I told you guys? It is not just the candle that formed, but the location where it formed matters a lot. Here now, we have ourselves a resistance level, right? And then we got an engulfing candle. At this time frame, let me say 5 minutes ago, a lot of buyers came in, gave us a very good bearish candle. Then the next 5 minutes, the amount of sellers that came in were just so much that it overpowered the buyers. And then it totally engulfed them. This is another sign that a lot of sellers at that point are there. Remember, as a forex trader, you want to follow the trend. They say, follow who no road. Follow the trend. A lot of people are there. You follow them, you take your sell, and voila, you make a profit. Now, the market came down to a demand zone. It gave us another confirmation for a sell. What do we have here? We have a doji followed by a bullish candle that formed where, guys? It formed at a demand or support level. Is a very good entry confirmation. Even though now look, remember I said it is not just a candle that formed, but it's the location where it formed. See, what do we have here? This, someone can call this a bearish engulfing candle. But did the market sell? No, it did not sell. Rather, what do we see? We saw another doji indecision. We even saw another inverted hammer. And what else? The next thing we saw was a very good bullish candle. This candle is not that it's the best engulfing candle, but it's also a very good candle. Some can also take that trade from the zone and the stop loss below. And the target is all the way to the previous high. And that is how you make your money. All right, but you need to understand market psychology. So that is why a lot of value has been sent to you through this course. So do yourself the due diligence, practice what you have learned, go through the charts and review them so you can be much more familiarized with these tools. All right, good. Now we also have something we call shooting star, a bearish reversal pattern appearing after an uptrend. Okay. Now, it's a reversal pattern. Like I said, it's not just where the candle, it's not just the candle formation, but it's the location where it formed. Now, you see these two candles that formed here at the demand zone or a resistance level. We got ourselves some bearish candle. Just call it a reversal pattern. All right. We got ourselves a demand zone. The market came in, it tapped into the zone. The next thing we saw a doji indecision candle. And then what next do we see? We saw a bullish candle. These three candle formation. All right. These three candle formation. Some can call it a morning star. And then what next? You take your trade, you buy to the upside because it formed at a demand level. Again, demand level is a psychological level. You want to take your trade at psychological zones, and you only take it when you get your confirmation, beautifully mostly from a candlestick confirmation. As you continue to advance, they could use maybe a change of character or a break of structure, even fair value gap fillings. But there are so many confirmations you can use. But one of the most important and valid and is the fundamental to every other strategy you're looking for, it is the mother at which everything was built, is candlesticks confirmation, which is why we started this our course with candlesticks confirmation. All right, so this is an example of a resistance level. A resistance level, this is how the market kept on reacting around the resistance level. Looking at this market psychology, you know what to do based on what you have learned. All right, you know what to do based on what you have learned. This is a very bad and strong bearish candle, but you cannot just enter at this point, okay? It's not just where the market formed. It's not just the candle formation, again, I'll repeat, but it's the location at where it formed. Look, it sold all the way. How much room do we have to the next support? If you are to take this trade, this is your trade, this is your target, or let me say this is even your target, your stop loss is here. This does not offer us a good risk to reward ratio, which is why we move on forward to understand what we call risk to reward ratio. Now, moving on forward, this is another third strike. the market came. After this third strike, what do we get? We get ourselves a very good bearish engulfing candle. Now, this is a place where you can take your trade. You take your trade here, you put your stop loss here, you take your trade here, you put your stop loss here, and your targets here. But then at the end of this trade, you're wondering, oh wow, what happened? I hit my loss. What happened? The market don't go in my direction. That's what happens actually. The market directions. Not all trades are going to be profitable. There'll be winning trades and there'll be losing trade. But if you're a good active listener and you communicate to the markets well, then you have more of the wins than the losses. If you look at this zone here, what do we have here? A very good bearish engulfing candle at where? At a support level. And what do we hear, guys? At the support level, the market tends to buy. Let's say that you saw this, you took your trade here, your entry is here, your stop loss is here, and you let your market ride all the way. This is the target, this is target. This is target 1, target 2, this recent high, and this is it. Easy peasy, you've made your profits. That is why it's not good to always adjust your trade unnecessarily. You need to build yourself, and when you take a trade, let your trade run for you, and then you enjoy your profits. That's how trading is. Imagine someone that took a trade from this zone, the market came in here, gave him a bearish engulfing candle, and then painfully he closed everything, then only for the market to come back to his entry, then all of a sudden achieving his targets. That's quite painful, right? It tends to happen in the markets, but you have to have a good trading strategy and stick to your trading strategy. And over time, for the fact that it's a good trading strategy, you end up being profitable. All right, good. Now, this is still the same thing. This is the hammer. These are different candle patterns. Remember, it's not just the candle that formed, also where it formed that matters. All right, so keep making your research, keep building yourself. Now, this is an exercise for this part. Okay, draw support and resistance line on any given historic chart, preferably, as I gave an example here, the US dollars. Identify and interpret the candle formations, the candle patterns that were formed there. Where you see doji, just mark it up. This is doji. Where you see a hammer, mark it up. Where you see an engulfing candle, mark it up. Where you see a shooting star, mark it up. And then understand how the market reacted. That is how you practice. Remember, practice make perfect. And you all here are students, learning and doing what? Improving. Also, for further research, also use your trading view. Okay, very important. And you can also make more research on Investopedia. All right, if you need more research, also you can always come in to ask us questions. We are here to guide you through along. So now moving forward, we have basic fundamental analysis. Okay, we have major economic indicators. Okay, now this major in the economic indicators, let me just list out this four we have here. We have the GDP. We must have heard GDP when we listen to news or economic forecasts. What is GDP? GDP is actually the gross domestic product. Okay, it's a measure of a country's total economic output. That's it. And the economic indicators. If let me say we have a negative economic news on a country economy, what happens? That country currency tends to depreciate. So we want a positive news on the GDP to tell us that, okay, this country is actually gaining strength. What do? You want to buy it and not sell it. So there are things you use for your analysis. We have three types of analysis, okay, mainly two, which is the technical analysis and the fundamental analysis. Technical analysis involves the reading of chart, and the fundamental analysis involves you using news to read your chart, economic indicators. Then the third one, which is not a good one, which is not to be called, is actually sentimental analysis, using emotions. You cannot use emotions to run the market or using guesswork. So that is why we don't call that. We just have two major base types of analysis, which is the technical analysis and the fundamental analysis. Please, beginner traders, make sure that you don't find yourself doing sentimental analysis, emotion analysis. Only trade what you see and what the market is telling you. Don't do guesswork here. What the market is communicating with you, follow it. If you don't understand, leave it and move on. Or you can ask an expert to guide you through so you can understand better. Also, the second economic indicator is the CPI, which is Consumer Price Index. It is a measure of inflation based on the price of the baskets of consumer goods and service. How do I put it? It's just the measure of inflation, all right, based on the price of consumer goods and services. All right, inflation also matters a lot. All right, now unemployment rate, the percentage of labor force that is employed and actively seeking employment. If unemployment rate is high in a country, that is not good for the economy. So that is a negative figure. So if you see it high in a news release, that means that economy is not doing well. But if you see it low in a news release, that means it's a good news. Now, interest rates. This is the cost of borrowing money because you have to pay back interest, okay? It is the cost of borrowing money set by the central banks, okay? So higher interest rates generally strengthen the economy. Why lower rates weaken it? How does this go? When the rates are high, people can lend out their money and they will collect interest. It makes it nice for investors. Investors will come and invest in that country. So when that country is borrowing money out, they're getting themselves good rates, returns. We all want higher return of investment. So if you see a country that is increasing their interest rates for people that are borrowing, some players, big traders can just go there, invest with the economy, and what happens? They are making their returns. So these are that on basic economic indicators. Now, this is how this news release can be done. Now, impact of economic news, they have a significant price movement. The moment that it drops, unemployment rate, if it is high, the market can just skyrocket downwards. Now, this is what we call recession. If that is job growth, that country is far from recession. But if there are a lot of people jobless, then they are very, very close to recession. So this is just economic indicators and how news can impact a currency pair. So this is a news trading tool that we use. This is my Forex fund, my FX book. This is the one I use, my FX book. I can drop it in the comments there. My FX book. There are so many others there. So use it to monitor the economic indicators. If it's a negative news, that means that currency is doing what? Going down. If it's a positive news, that means it's doing what? Appreciating. Awesome. Now, we're still keeping everything on a good level, not too complicated, but very easy to understand. Forex trading is not so difficult, but you need to be properly groomed, which is why we're taking the time to do what we're doing here. All right. So now here is an example. This case study, that was a negative impact on the US dollars. What happened? This is it. USD JPY. It's actually sold for that time period. All right. That is how it is. That impact actually drive the market down. Now in this zone, now look here. The market came here finding support level, not just the support that it found. Maybe there was also an underlying news. There could be a positive news now on the US dollars. Then what happened? Appreciated. Also, there might even be a negative news on JPY. So when JPY is going down and US dollars is just there after the down in it has, then it can actually appreciate. Okay, this is how currency actually works. Remember, when you're buying the quote. When you're selling the base. All right, that is how it works. Sorry, when you're buying the base currency, and when you're selling the quote currency. Yes, so this is just it. We have two forms of analysis, the technical and the fundamental analysis. Here, guys, we had ourselves a good bearish engulfing candle at a resistance level where what next? The market sold us all the way. Here we have another thing, a good bullish engulfing candle, and what happened? The market actually appreciated. This was another confirmation. This was a bullish engulfing candle. This was a bearish engulfing candle, but the sellers were not strong enough to get down to this bottom. Then what happened? We got ourselves another good bullish engulfing candle, which spikes the market all the way back to our resistance level. Then at the resistance level, what do we get here? A lot of price shake, a lot of price movement. Eventually, we got ourselves a very good bearish engulfing candle, and we'll put our entry at this point, our stop loss at this zone, and we'll target all the way down to the bottom. So technical analysis and fundamental analysis are what to use to listen to the markets as a very good, effective market whisperer. So this is another exercise. The course of this exercise to ensure that you're actually learning, not just listening or watching the YouTube video or learning, but practicing is the way to actually grow. Okay, good. Not that you will always be accurate, but give it a try, because it's when you feel that you cannot get feedback to move forward. So give it a try. Give this a try. Okay. All right. So I need you to match economic indicators with a definition. All right, as I said, inflation is very easy. You can even go back to the video and get that. Now, analyze the impact of a recent central bank announcement on a currency pair. For example, today now, there was high impact news on US dollars. That impact was actually, I know I traded it today. That impact was actually positive for the US dollars. If you go to the US dollars DXY, you will see that US dollars actually appreciated. That is the impact of that news. So technical analysis and fundamental analysis, they actually work hand in hand. The news is the news. Now, technicals will tell you when to enter. Okay? Technicals are just a bunch of people there trading, and you're seeing what they are doing due to the market psychology. You reading the candlesticks, you reading the chart. So that's that. But news is what can tell you what will happen ahead of time. So you can say news will tell you if it will sell or depreciate, and then technical analysis will tell you when it will actually sell or depreciate. That is how it is. So despite the news you might have, let technical analysis give you your confirmation. The both of them are very needed. If you're trading one without the other, it's as though you're one-sided or you're one-eye blinded. But you need the good eyes to see. So you need to understand the both of them. All right, very good. Now, for more resources, for more learning, we can use economic calendars, my Forex Factory, my FX book, any of them you want to use. And for more understanding on fundamental analysis, you can go to Baby Picks. Okay, it's a website you can get to read more. Also, you can also meet us and ask us some questions. We can always be there